Alrighty, so we are now recording. This session is going to be recorded through Panopta and through the Zoom. If the Panopta works, then we're going to switch to just Panopta. So those that are watching at home and those in class, I would at least go in and check the Panopta video. If it's not working, please let me know, because if I think it's working and it's going, then we're going to switch to that, and then if you're having an issue with the Panopta video, then you might lose out on the lecture. So just keep that in mind. Any general questions? I know we've kind of had our own Q&A before class started, but is there any others that we can knock out before we get started? Yes. Yes, every member of the team needs to submit something, so I can check off, one, that you agree that you are in this team and that y'all have agreed. Two, it's to actually give you that grade, because until I create the teams, it won't count up under your assignments yet. So, all right, any other questions? Everyone felt good about week one? Still here as a finance or accounting major? Haven't changed your mind yet? All right. I hope everybody fared well during the storm. My family kind of had some issues. So sorry about not showing up to the Friday Zoom call. Once I posted the video Wednesday, I kind of checked out and didn't think about it until I got emails later that day saying that I was there. So that's on me. I will be there going every Friday forward. So yeah, welcome. Found the place. Do y'all have any questions about week one before we go into chapter one? Y'all good to go? Alrighty. So with chapter one, financial accounting and accounting standards. Was any of this information new to y'all, or was it all pretty much listed in principles? Oh, right. So what? And y'all are the Monday class, so y'all got the short end of the stick because I'm going to ask this question every week. Because again, none of this information is new. We're going to take what you learned in principles and complicate it just a little bit. So how did this chapter complicate what y'all learned in principles? Anybody have a thought? Did everybody read the chapter at least? Yeah. So it provided a little bit of the history and the fact that we have FASB, we have the GAAP, but it wasn't easy to get there, right? So this was my takeaway from the lecture. And today's passcode is accounts for people. That was my thought throughout reading that chapter, is that in principles, they just told you these were the rules. They didn't bother telling you how they got to the rules. They didn't bother telling you the hierarchy of it. This time we're complicating the fact that this entire process, and I went back and got your week one graph from principles. This entire process is being done by people. So at each step of this way, and on the outside, making the rules and regulations for this, there's people. So why is that an issue? Why does that create a complication? People are janky, dirty. Okay. You're right, you're on that, but unethical.
Yeah.
So sorry about the way the slides are, but I broke that down into error and intent. Whenever there's a person involved at any given situation, you have the chance of an error. But besides that, as he was suggesting, people are janky or unethical, and so they have intent. Okay, and that's on the negative side. even sort of on the positive side, the people wanting to do good, we still have intent. There's a reason for us doing, and you saw it last lecture, I kind of made a point of that. The legal definition is called intent. Another word to say that is purpose. Everybody has a purpose. Everybody has a rationale for doing something. And so when you get these people involved, they're going to have their own purpose. They're going to have their own wants, their own wishes, their own desires. If you look at the tax code, that's the best example of this. Okay, the U.S. tax code in its entirety can fill this entire room and many, many more, because every politician that has come up has had intent on either making his own paycheck better through different investments or sorts, or their constituents better by making a tax code that exempts certain inventories or things like that. And so it's very important as we go through this chapter, as we go through each of these assets, as you start learning the policies and procedures behind it, is that it's all designed because of the fact that we have people involved. Make sense? Any questions? So with that in mind, we're going to be focused on step 7 here throughout this class, is preparing financial statements, because that's where financial reporting exists. At the same time, in order to get to for the financial statements, we have to go all the way back to step 1. And so each of the semester as we go through, I want you to keep this in mind. What step are we in? Who's involved? Where can an error occur? Or where has somebody put their intent? Okay. For y'all's group projects, that's going to be the biggest thing, is you're there looking at the GAAP, you're there looking at the IFRS, comparing the two, but realizing that they're there because someone had intent. Why was that policy or procedure put in place? Was it to prevent a certain thing? Was it to create a certain thing? Is there a benefit involved if we do it this way? Why do we want to do it that way? Okay. Oh yeah, so your homework, this is up on its own. So there's questions in the back, 1, 3, and 17, concept analysis 3, 7, and 11, and then the IFRS question 7. You'll find all of that in the back of the textbook. Most of it's discussion type. There's a few multiple choice. Again, these lectures are on, and the homework assignment has it by itself. All right, so we're going to briefly talk about the two. Does anybody want to define managerial accounting for me? Okay, guys, this is going to be a quick lecture if I don't get some discussion.
Managerial is more how to apply the financial information to you.
Who applies it?
Like managers, and they're trying to see their overhead or different expenses where they can cut things so their revenue can go up, or they can pay their salaries, things like that. So it's more application for the internal group.
Okay, so that's the key word right there, internal. Okay, so everything you said is relevant for both, except for internal is managerial. Okay, so both accounting, both managerial and financial accounting, the goal of it is to make a decision based off of the facts and figures present. Okay, the difference is managerial, it's an internal decision. Okay, and because it's internal, it's not as heavily structured. So a manager has the ability to change its accounting approach. If they think that the cash accounting presents more information to them in order to make the decision that they're allowed to make, they can go ahead and do the cash accounting. If they don't want to include depreciation because depreciation is handled by corporate and it has no impact on them, the managerial accounting gets going under you're using the same definitions, the same terminology, everything you will learn in this class you will use for managerial. You're going to go into it a little bit more depth in your own managerial accounting course. But the key is that in that course, you're dealing with internal. And because you're internal, everybody already has some information about what's going on, right? You're not going to be a vice president of a company if you don't know what that company does, if you don't know how that company generates its revenue, if you don't already have some basic understanding of that company, of those numbers that are coming to you, the idea is you're already in a place of knowledge. And so we don't need to heavily document and rely on all of this. Financial accounting is the opposite. It's external. The goal of financial accounting is anytime you take those numbers and you put them outside of your company. So either if you send it to your investors through your 10K, if you send it through your bank as a debt covenant requirement, if you send it to the newspaper because you just want to announce whatever you're announcing, anything that gets reported externally falls under financial accounting and falls under all of the rules and the guidelines that we're talking about here, okay? And the reason for that is, again, because there's going to be errors, there's going to be intent and all that. The SEC, the government, we're trying to prevent your layman from misrepresenting those numbers and facts, okay? So it's there to protect. But at the same time, you still have people all throughout there. So it's not going to be 100%. Okay, so most of the time, if you've ever invested in a stock, if you have one of those apps that let you do that, they ask you what your level of experience is. Because even the SEC says that, hey, that with a college degree in accounting is going to know information that your typical person on a 401k is not. Okay, and so based off of where you are and who you're representing, the SEC is going to tell you whether or not you can sell to this person or whether or not you can sell to that person. So we're going to go into all that. So with that in mind, I just kind of defined what financial reporting itself is. So again, it's any external numbers and facts that's presented. So like I said, your debt covenant to your bank, your 10K, quarterly earnings statements, your tax return would go under the financial reporting because at the end you're reporting it externally to the IRS. Now they have their own rules, regulations, and all that. It's not as simple as now you're external, these are the rules you apply to, but it still falls under that financial reporting. All right, so does anybody want to define capital allocation? What is capital? Money. So what's allocation mean? Okay, so capital allocation would be the distribution of money. Who goes under a capital allocation? Who needs to do that? Who would need to do a capital allocation here? Banks? Everybody, right? Who in here has unlimited amount of money? Nice, all right. Yeah, so that's the point, is that no one in here has unlimited amount of money. Banks don't have unlimited amount of money. Even the federal government doesn't have, they think they do, and that's another story, but they don't have unlimited amount of money. So with that, we have to make some type of decision. How are we going to allocate our sources, okay? So internal, under managerial accounting, that's your managers deciding, do we go with this investment? Do we go with this investment? There's project A and project B. How do I go about deciding which project to choose? Okay. From an external perspective, you have the investors. You know, like I said, there's thousands of apps out there now. You can go in there, put $10 down, and go buy 100 different shares of stock. What shares of stock are you going to buy? Who decides where that $10 is going to go? Okay. Banks have to go through the same thing. They have a limited amount of funds. They're required by the Fed to keep a certain amount of cash on hand. So when you go to them asking for money, you get into this list and they have to decide where they're going to spend that money, okay? And as accountants and as finance managers, that's our job, okay? Is to go in there and figure out different decisions and give them the best guess approach, okay? Yeah, we're really going through these so fast. Okay, so as you're going through, this is how I would set up my studying. And again, I'm under the assumption that y'all know how to do chapter outlines and So I haven't really planned on going through the details of the facts and figures, but this is kind of where I would go is each time one of the books represents the SEC or they mention something out there, either a publication or a group, I would set up this, and this is how I would study, is what does that group govern? How do they govern it? Is it through an elected board? Is it through pronouncements? Is it through standards? Do they rewrite the law? And then whether they're a government figure or a private figure. Okay. Now, when I was in this class, it was a lot harder to understand all of this because we had to actually go to the SMART lab. We had to use the one sign off that was approved for the entire LSU to go through the FASB's codification, and you had to pay a monthly membership to actually go in there and get all of the pronouncements and do a research project. Now y'all have Google. So I'm not really focused on learning each of these because at any given point, y'all can go Google it. It's out there for everybody. They've made it incredibly easy. The FASB codification includes everything that came before it. And someone sent the email last week and said, are these now just suggestions? No. If they've ever made a pronouncement, a bulletin, a newsletter, if someone got on the radio from the SEC and said, this is how I think that you should do your accounting, that's not a suggestion, okay? There's a hierarchy here, and it starts with the United States Congress, SEC, who they've all represented, each of the ones in the past. Is it a bulletin? Is it a pronouncement? Is it a standard? There's a hierarchy involved, and sometimes they conflict just because what the AICPA wrote 60 years ago is no longer relevant. They did a convergence between GAAP and IFRS. So the best place to go is the codification because it'll show grayed out if it's no longer relevant, but they will also show still recording there. I'm still recording there. Okay. I think we're back. We'll see after. Okay, so there is a hierarchy. Anytime that you go through this and think about where you're on that accounting cycle, okay? So the FASB is there for the US GAAP, which is only relevant if you're sending it through an external vendor. The SEC is kind of over everything. The AICPA is related just to the accountants now, but they do still have some form of control because at any point they can say, that's unethical. If you follow through with this procedure, we're gonna revoke your CPA license. And then the SEC says, well, you need a CPA license to sign a 10K report. PCAOB says you can't do an audit unless you have all of these ducks in a row. Okay, so as you're going through this, each time you hear all of the alphabet soup, that's what I would take a second and make sure you can answer these 3 questions. Okay. The discussion board for this week, your book made an outlandish claim and they just kind of glossed over it. I wanted to take a second and make y'all think about that. So the claim is that the SEC generally works well with the private counterparty. And I want y'all to answer whether or not you agree with that. That's going to be your discussion board for the week. I've already given you my answer. We'll just go through the last of it. So in the United States, we're under what's called common law. Has anybody heard that term before? Did they gloss over it in principle? Why is that important in terms of accounting? I'm going to take a coffee break while one of y'all answers that. Why is common law important in terms of accounting pronouncements? Start easy. What is common law?
Allow everybody to survive.
Not in your textbooks. Okay, so common law in the United States means that if Jimmy can do it, I can do it. If somewhere in the court system, a judge ruled in favor one way or the other, then every other time from then on, a judge in that same jurisdiction under that same policy is required to still go off of that pronouncement, okay, until it gets all the way up to the Supreme Court, in which they then say, this is the reason why, and we're now changing it, okay? The way common law works is that whatever decision happened most recent is the decision that needs to be applied. So again, any thoughts on how that complicates your accounting pronouncements? Okay, we don't need to jump straight to unethical each time, but it's under that same thought and theory, is that if me as an accountant wants to do an accounting, so again, we're going back to analysis of business transactions. So we've determined that there is an economic event that occurred. How do we account for it? And you'll hear everybody has a different way of why they want to account for it. If at any point someone says, no, that's not right, I'm going to take you to court, you did it wrong. Okay, and it has happened. The biggest example of this is the IRS. Someone takes something as a deductible because on line 3 of the 900-page report that they issued 10 years ago, there's a line that says you can deduct certain assets, but they don't define what certain assets is. That's an interpretation. So we get into this court case where me as a tax provider said, I'm going to deduct this, and the IRS said, no, you're not. A tax court goes in there and answers which side of it. From that moment on, everybody is now under the threshold of whatever that court decision was. Okay. So when you go through all of these hierarchies, realize that at any given point, someone can take that decision to court, and if that court determines one way or another. So even though it's not a FASB pronouncement, even though the PCOB didn't roll it down, if somewhere along the line a judge ruled in favor one way or the other, that's now a legal standing procedure that we have to follow, okay? And that's important to note because it complicates all of this. Now, most of the time, the pronouncements have guidance in there and they give specific examples so that you won't have that. IFRS, international, they don't have that common law conundrum, and they end up keeping things pretty broad in general so that you don't end up getting into those type of specific questions. But in the US, it is very important to know, and it is something that you need to realize each time it goes through. You could literally have an entire class, an entire semester's worth on answering that. When I was at your time, it was before Convergence started, that literally was everybody's dissertation at the time. People became doctors in accounting answering the question of, do you go with the principle-based model or do you go with the rules-based model? Because of the way that the US system is set up, even if we did go to a fully principle-based model, which means, hey guys, just don't do wrong, you know, because of common law, we would end up in the same point, okay? Because of the fact that at some point, that principle, someone's going to try to push the envelope, it's going to go into a court case, and then someone's going to decide whether or not that envelope was pushed too far or if that was acceptable. And then you're right back into the same situation where you have all of these rules, policies, procedures down to the T. It's hard to say which one's better because we only have really about 200 years of capitalism that really gives it, and compared to the 4,000, 6,000 years of monarchies and everything before that, it's really hard data set to tell what's one way or the other. The Convergence Project is trying to find a middle line between that, and you'll see in y'all's group projects, somewhat get there, somewhat don't. But yeah, in terms of which one's better, if I answered, it would be an opinion. Any other questions, comments?
So common law is like basically above already.
It's in conjunction with it, okay? Because when that argument goes in front of a judge, the judge is going to see, well, was there a pronouncement already made? Did the SEC already decide this? And there's a hierarchy and that you'll learn as you're going through this. Like I said, the AICPA guidelines, they're still there, but if the FASB came out with something more relevant, or the PCOB, is the FASB will look at the accounting treatment of it. The AICPA will look at the accountant treating of it. Did they do something ethical? Do they need to have more rules involved? And so, again, it's part of it, but at the end of the day, if a judge makes that decision, then they're going to have to go back and reword their pronouncements. Because what will happen is these pronouncements will be very vague, or they'll have something that they didn't think of, especially with the way technology works, okay? So there was no way, never in any of these guidelines, especially when you look at about 85, 86, there was no guidelines on how to value an internet startup, right? Because 85, no one knew what the internet was, So because of that, there's a lot of the times where they just haven't gotten around to issuing a pronouncement yet. So you'll go off of what the judge decides. Then they'll make a pronouncement. And then again, common law is whatever's the most recent court case. And even then, you have lawyers involved, and accountants will be in there. They'll go through and say, okay, well, this was the set of circumstances, situations, and ideas that existed at this time. That's either relevant or not relevant to our situation because of this, that, and the other, right? So it becomes a more granular, detailed, is this the same as this? Because if there's a difference, well, then you're not under common law situation. The judge or the jury can decide based off of the fact that this is a new situation. So does the same set of circumstances apply to this type of situation? A good question. Any others? Is this interesting? Am I adding to what y'all read in the book? No? Thought this was going to be the 2-hour lecture slides, and now we're finished 30 minutes into it. So either y'all are just awesome, or maybe I should go back to do some more facts and figures. So as you can see, accounting is a lot more complicated than what principles let on. Okay, and all of these are in fluctuation. Okay, this part, what you learned in principles won't change, but as you'll start seeing that complication and realizing why they do a certain thing. For example, in principles, you learn the different ways of accounting for inventory, but as you saw then, and you'll get into a little bit more now, that makes a big difference on just an accounting change. Because again, we're not the ones creating the economic event. We're not the ones that are, it's not our capital that we're allocating. And so you would think that everybody would agree on something. But again, because we each have a different intent, the IRS wants more taxable income today versus later. As a company, if it's only going to be a difference of cash, I'd rather pay that cash later so I can use it for today's investments, right? I've learned time value of money. So there's an intent from the IRS that wants it one way. There's the intent from the management that wants it another. That's where you get into a lot of these situations. Let's go to the last slide. Current issues. So again, it's taken a lot to get to this situation, to where we are today. Compared to where we were, it really depends on what exactly you're looking at. The point of this chapter was that it's not perfect. There's continuous improvement. Sometimes we make a mistake and we have to go back, and some pronouncements end up costing us a lot more than they are, depending on what side of the aisle you're on. Either you want more regulation or less regulation. The point is that in 10 years, they're going to have a completely different set of pronouncements that might look similar to what we have, but hopefully a lot of these are going to be fixed. I did want to talk about each one of these a little bit. So non-financial measurements, we're accountants, we're finance majors, are, as everyone in here said, that they took this class either because of money or numbers. That is our go-to, but as we're learning, a lot of non-financial measurements can make or break a company, right? If you looked at the startup of Amazon with Bezos in his garage, you wouldn't think that that company would have made a success based off of the definition of success and the history of success at that time. There's other non-financial measurements that we, as an accountant, as try as we might, we can't put a figure on it. The biggest one in the last 10 years is going to be on the green initiative. So companies have literally made or break themselves because of how they treat the environment. So you have one company that went bankrupt because they were dumping a certain chemical in the pond. They didn't know any better. This was 1940s, 50s. You know, they've been doing it for the last 60 years. Come to find out, the chemicals that they've booked into that lake have flooded into the population. That population has 10 times more cancer patients than the other populations. It's not until later that we can start putting numbers to things, but even then, how do you put a number on the value of life, and what sort of liability are you required to book? Those are something that we might end up getting to an answer, even though maybe it's not an ethical answer or a comfortable answer to get to. But we do need to start paying attention to what's called non-financial measurements. What success or failures of a company can be attributed to those type of factors. More and more people want forward-looking information. They've started putting forward-looking information in different prospectuses. So it typically won't be in your 10K, it just depends. But more and more, you'll get earnings calls, or there's projections of what the business thinks that they're going to be doing next year. And if they don't make or break that, whatever that expectation is, it has some impact to what their stock is. So we're trying to figure out, and this is going to be more on the finance side of things than the accounting things, but there's a pool that investors want to know, that forward-looking information. What do the company think that they're going to be in next year, 2 years from now? Because obviously the management has more of an insight to that data. But the problem with that is you can't validate those numbers. I can tell you that tomorrow I think I'm going to teach a class for $2 million, but unless I find a university out there willing to pay me $2 million a course, that's not going to happen. And so figuring out a way to provide that forward-looking information, but still make it accurate, reliable, all of those things that we want, it's becoming an issue. Soft assets, So these are things that, so soft is in the terms of you can't hold it. So that they're becoming a big stock. So everybody, I see memes in those posts about the fact that Bezos has, I think he's up to $200 trillion, something like that. It's a hard, or billion, sorry. It's a hard number to think of. Realize when you hear that he doesn't have a bank somewhere with just stacks of $100 bills. I mean, he probably does have a little bit, but the entire billions of his net worth, it isn't in cash. Okay, it's in the fact that he owns Amazon. Most of what Amazon, it's not brick and mortar. They have certain financial instruments that they use to kind of keep themselves, but a majority of the valuation assigned to Amazon, assigned to Google, is the intellectual property. And that's something that he can't just sell, because no one's going to buy $200 billion worth of this intangible property, because no one has that kind of cash. So how we value those soft assets, especially in today's market, is becoming more and more of an issue. GAAP will follow it's only worth what somebody has physically paid for it. So they'll go through the historical cost method. IFRS has allowed for some what they call mark to market, and depending on what the asset is, but that's kind of where we're at today, is learning on how do we account for those soft assets. Another big one is your they call the customer list. So in manufacturing, it's not really what you know, but who you know type scenario. And so there's certain companies out there that will only do business with certain companies. Well, that relationship is worth money. As an investor, I'm going to pay more for this company if they have those relationships intact and they've proven those relationships, compared to a company that's just starting up. Even if everything's the same, those relationships matter. And in my cost allocation, I'm making a different decision because of that. We're going to have to find some way of putting that into terms that investors can understand. And investors are really only looking at numbers. So what numbers do we give them for that? Timeliness is a big one. The bigger you are, the less time you have, which at the same time is counterintuitive, because the bigger I am, the more work that I have to produce these numbers. But the more that the stock market is depending on these numbers to come out, so it's shortened. I'd say anywhere between 45 and 90 days from the time of the year end to when these reports are getting. And so if you know the stock market, those 3 months, that can make a big deal. So how do we get that same information with the same reliability of data, with all of that, into a quicker report? And then understandability, because of the fact that anybody today can go out there and buy a stock. They're making a capital allocation. They're in this decision. We need to be sure that we as accounts are protecting those investors. How do we go about doing that with everybody at a different level of education? And so it's how do we make, has anybody seen a 10K at this point? What's called the 10K annual filing? One of your homework assignments is to go look one up. So every company at the end of their year, if you're on the SEC, if you're on the NASDAQ or any stock exchange, the annual report's called 10K. It's my company just released theirs. It's a 152 slide PowerPoint deck, and theirs is pretty light. Exxon's about 300 pages. And again, the main financial statements is 4 pages. You have 1 page for a balance sheet, 1 page for an income statement, 1 page for cash flow, and 1 page for equity. So the other 140 pages is on all of this information, because that's what the investors are wanting. And it's part, and we won't go into detail. We'll go into what it's called the disclosures. We'll start talking about how we fill out that 300 page. But realize most of what we talk about in class is going to be on those 4 pages. And anytime there's one of these issues that are associated with it, you have your journal entry that you post on that page, which will go into your financial statements. But when they issue that financial statements, we issue that 4 pages with 250 pages of documentation of why we chose the LIFO method, why we chose not to include these on there. And so when we get into timeliness, it becomes a lot bigger a deal to get all of that correct. And then the final thought is that there's a cost benefit to any type of disclosure, to any type of data, any type of fact finding. For us as accountants, we're not doing this for free. You might be on a not-for-profit volunteering your time, but for the most part, our time is not for free. The systems that we use to track the inventory, to track the different data, that's not for free. And so you can imagine, I was supposed to do a pendulum here, but you can imagine the seesaw of cost or benefit. The investors aren't the ones paying it. They sort of are, because the more it costs, the less that goes to the bottom line, which creates a smaller stock. But for the most part, it's not coming out of their own pocket. So they want as much benefit as they can get, and they don't really care about the cost. Management is the one that's going to shoulder that burden. So when the PCAOB came out with their long list of laundry that everybody had to complete, and we now had to have new statements and new signatures, that increased the costs. Right now, they're arguing about the Banking Act. I forget exactly, but Obama administration signed into legislation a lot of different initiatives that were meant to have the banking industry more open in terms of what type of numbers they were reporting and why they were reporting it and when they were reporting it. All of that came with a huge cost. And so today, now that we've had 5 years under those guidelines, the companies are going in and saying, what benefit did the investors really receive by us giving that information compared to the amount of cost that we've had? And so as you're going through these policies and procedures, just realize that at the end of the day, time is money, effort is money. These systems aren't cheap. And so, yes, we could spend as much time as possible and get to some degree almost to 100% of certainty. But if it doesn't equate to a benefit that's worth that cost, it's not going to happen. So think about an inventory count. Every day I can go into the warehouse and I can count every single nail at Lowe's to make sure that we know exactly how much inventory Lowe's has. But if you've ever worked fast food and had to do an inventory count, it's a lot of work. It's a lot of moving those boxes out, doing that. So we're not going to do that every day. But then if you don't do that every day, then somebody can go in and steal fast food. Someone can go in there and make them a sandwich. How do we track that? And so wherever you land on the cost benefit, you need to have procedures in place for whatever those don't. All right. I think I filled up an hour. So any questions at this point?
What we should do on Sunday?
Yeah. Yes, you'll use that same book. So this class will go all the way to chapter 14, and then which is all about assets. The first 14 chapters are all about assets, and then your intermediate 2 will take over from there and do all about liabilities and equity. Y'all are free to go. I'm gonna hang out for a few minutes if y'all have any questions. So.
You just told me those codes are to watch the online video.
So everybody, in order to track attendance, even if you're here or not, there's an assignment on Blackboard that says it's part of week 2, Monday's passcode. Go open that assignment, type in that passcode, so I know you're either here or you watch that video.
Every day, every Monday,
Every Monday and Wednesday there'll be one. The Friday is your discussion board.
just telling us
Oh,
he
yeah,
didn't do it
Friday.
last
Hmm?
week. He's just telling us he didn't do the one for last week.
But he didn't sign up till Friday, so that's okay.
On Friday, so.
Patience will turn.